The craziness continues in the housing market. Mortgage rates are rising, inflation's rising, buyer demand is still high, and the inventory is still low. We're going to take a look at the local market as well as what the experts are saying what's going on nationwide for the housing market. Hi, I'm Stephanie Souza with Modern Nest Realty, located in Orcutt, California on the Central Coast. We're going to take a look at the local market of the Santa Maria and the Orcutt areas, and then we're going to jump over to the housing market nationwide. In Orcutt, we saw a 24% increase in sales price over January 2021. The average housing price in January 2022 was $627,000, and last year we were at $507,000. The days on the market dropped 19% compared to last year. January of this year took 22 days to go under contract. We didn't see movement in the amount of inventory that we have in Orcutt. We're still sitting at 36 properties coming to the market in January in 2022, which was about the same as last year. In Santa Maria, we saw a 16% increase in the housing price over January 2021. This year, it cost an average of $526,000 to purchase a home in Santa Maria. Last year, we were at $455,000. The inventory actually dropped 41%. In 2021, 49 homes were sold in January in the Santa Maria area. This January, we only had 29 homes sold. Days on the market decreased in a big way. We had a 40% reduction on the days on the market. So it only took 12 days to get a home under contract in the Santa Maria area this January. Okay, let's switch it up a bit and talk about the elephant in the room, inflation. We all see it happening, we feel it happening when we're at the grocery store or the gas pump. We also see it in the home prices and the rent rates as well. When things start to rise, one of the silver linings that we look at is being able to lock in your fixed monthly cost of homeownership. This will actually help you against hedging against the inflation. This slide here that you're looking at shows that homeownership as a hedge against the inflation rate. So let's break this down a little bit. The blue bars are the average inflation rates for the decade, and the green bars are the average home price appreciation for those decades. So homeownership outperformed inflation quite a bit. Let's talk renters. We know that mortgage rates are projected to keep rising, and we know that rental prices are rising as well. So what does that mean at the end of the day, right? Well, somebody who continues to rent but could buy is taking on the additional increases in rent year after year. Plus, it's going to cost them more to buy a home down the road. So it's really important for renters to understand this dynamic, and I think the next visual really helps shows how rental prices compare to the inflation rate. This shows that rent increase has been greater than the inflation rate in most years. Homeowners are shielded from mounting rental prices because their cost is fixed. Regardless of what's happening in the market, they're locking in that payment at today's cost. Tangible assets like real estate get more valuable over time. You've seen that in the graphs, and this data that we were showing you, it shows that buying a home is a good way to spend your money during the inflationary times. We've talked a lot about home price appreciation, and I'm sure you want to know where is that headed as we have this conversation, and we're thinking about rising prices and how homes aren't immune to that. That's for sure. So let's take a look at this next graph from the Home Price Expectation Survey. And I think this gives you a really good, clear picture of where the home prices are projected to head according to the experts. Not me, it's according to the experts. So what are you looking at? These are divided into groups into optimists, pessimists, and the optimists being the ones projecting the most appreciation over the next 5 years. And the pessimists estimating on the lower side. Together, all that combined, by 2026, it's gonna be over 23% increase in price. Rates, where are we at? We're at a super low rate in the thick of the pandemic, but things now are starting to change a bit, right? We can feel that happening. We have seen rates tick up, and a quote according to Freddie Mac, as mortgage rates rise, we do expect some moderation in housing demand, causing the housing price growth to temper a little bit. However, the combination of a large number of entry-level home buyers facing a shortage of entry-level inventory of homes for sale should keep the housing market competitive. We are expecting the purchase market to grow and the refinance market to constrict a little bit. This is the 10-year treasury yield. For the last 50 years, the relationship between the mortgage rate and the 10-year treasury yield has been almost the same. When the Fed raises the rates, it does not control the interest rates. However, it hopes to influence it. So keeping an eye on the treasury yield is a good idea to see what is coming down the pipeline for the housing interest rates. Okay, I want to spend a few minutes on the forbearance situation. Take a look at this slide. It's an update on how many loans are in a forbearance program. Only about 1.4% of all mortgages are in forbearance. So we're definitely heading into a better position as we're coming out of the pandemic crunch that we experienced earlier. 38.1% of homeowners are exiting the forbearance plan paid in full. 43.7% are working out plans. You can see that in the section in the blue. This is the game-changing section. We did not have that section last time around when the housing bubble burst. 18.2%, or the section in orange, is the homeowners that are not in a plan and a little bit of trouble. However, most have at least about 10% equity in their home, and they might be in a situation to sell and walk away with a little bit of money in their pocket and not be in a forbearance plan. Lastly, let's talk about foreclosures. As you can see in 2020 and 2021, we were well below the average foreclosure quantities that we experienced in the normal market in 2017, 2018, and 2019. We are at an all-time low for foreclosure activity as a whole. We may see a bit of the uptick in foreclosures a little bit in 2022, but we're not expecting a big increase and still way below the average in the normal years that we saw in the last few years before the pandemic. Hoping this was helpful to recap on what the market's doing. And as always, if you have any questions, please feel free to reach out. If you have found this to be helpful, as always, please share with somebody that might find it beneficial as well.